Right. So you can start now. Huh?
Thank you very much. Good evening, everyone. Let me hope all of you are doing well and you are keeping working hard as usual. And the result or outcome from your hard working is all about success. That's why we are here today in this session organized by Equipa, which has a name of reminding you the key tips of handling questions and passing through the more examinable questions or topics. And it is a very wonderful moment and a great opportunity to all of us to start over again and see how we can work together to achieve on this successful. Let me hope all of you are going to be with me like how we did in the last session. And today we will not emphasize in the notes, but we are going to focusing on past papers, especially on the key examinable parts, which are the APV, adjusted present value, and business valuation, merger and acquisitions, some part of working capital, which is a advanced part, and hedging. Those are the parts we are going to cover in this session. I want you to participate as usual, so that we can be supplementary to each other. We can help each other to understand each and every point we are going to cover here. Thank you very much. Without taking much time, and we still have a lot to cover, I may start by now. And remember to inform your neighbor to please come. Tell them to attend. You can communicate with them with through chat, WhatsApp, or you can use a call. Please tell them to come. We are going to rush. We are going to rush, and I don't want anyone to be lost here. It is our last session, and I want it to be productive to all of you so that we can be ready for this coming exam without any hesitation of something that you don't understand well. That's why ICPAD have decided to organize this session. It is a very useful for a lot of you to help you to keep moving forward and keep emphasizing on the most examinable part. Yes, thank you very much. Let me hope all of you are going to invite your neighbor, your colleague, to come. Let me share my screen so that we can start. Thank you. I want you to confirm whether you are getting my screen. Okay. Oh, this is our Excel sheet of our last session, and I'm going to add the workings of today so that we can be able to combine all of them together by avoiding the loss of one of it. Okay. Due to In the last session, we had stopped at asset replacement, and the part which was remaining on the advanced investment appraisal was all about adjusted present value. Adjusted present value is what we are going to do here, but we will focus on practical, no theories. Adjusted present value. So, unadjusted present value, which is APV, it is the part which is mostly examinable in most exam. So that I would like to encourage all of you to be with me as you did in the last session. I don't want any one of you to be dormant. I want all of you to be active. I want you to make me work for you, and all of us together, let us be a team. Let us cooperate together to achieve more. Then, adjusted present value is also advanced development techniques which recognize the financing effect of the project. As we have seen, we have learned about NPV, and this NPV is one of the methods which is used also to apply the investment. And under this, nothing much in this except that we focus on the outflow, the initial investment, and the expected cash flows from the project we are invested in, and you consider also the taxation effect, inflation effect, and after that, you discount and compare discounted cash flows with the initial investment to see whether your project or business or company is profitable or not. Once this NPV is a positive, your project is said to be profitable. You accept that project. Otherwise, you reject. It is equal to the total discounted cash flows minus initial investment. Initial investment is the formula for NPV. On the adjusted present value, no, Imrans, I'm not yet attempted the question. I'm just introducing the APV, all about APV. I'm not yet started the handling the questions. I'm still waiting for your colleagues to attend. Yeah. APV is advanced, is an investment appraisal techniques that consider the effect of financing. This means what? Normally, under NPV, there should be a decision of rejecting a project, and in reality that project is profitable, and you might reject or accept the project when in reality that project is unacceptable. Due to under NPV, we then considered the effect of financing. We didn't consider the effect of financing the company, the debt effect. It was not our concern under NPV. While APV comes to address the issue of rejecting a project that should have been accepted. And under this is where we'll see how the project should be benefiting the loan that has used to finance it, whether we will see the difference benefit like debt tax shield, debt tax shield, and when there is a subsidization from the government, of course the rate or the interest on that financing is always low than the market loan or bank loan. Yes, under APV, there are like 3 or 2 steps. There are 3, let me call it 3 steps of calculating APV. First step is all about we are going to determine the NPV, base case NPV. Let me call it base case NPV. Base case NPV. Under base case NPV, remember, due to there is no financing effect and there is no debt embedded, considered, included, we discount it by using cost of equity or cost of ungeared business. Daniel, yes, I will share the summary, don't worry. Don't worry. Yes, I was saying that due to it is financed by equity only, this base case NPV should be discounted by using ungeared, by using cost of equity. Let me call it cost of equity. Yes, cost of equity, cost of ungeared business. May even call it like this, cost of ungeared business or capital. The second one, we are going to determine the tax benefit. Determine the tax benefit or PV of financing effect. Financing effects. PV of financing effect. After that is where we determine our actual activities of finding out APV. Then last step is where we find calculate calculation of APV, which means APV is always equal to base case NPV, base case NPV plus debt financing effect. Debt financing effect. Yes. After this, once you take NPV, you have calculated by using cost of ungeared capital or business, you add the effect of obtaining a loan in the business. What you get is what we call an APV, adjusted present value. We are just looking for how we can decide on whether to accept or reject a project by considering the effect of that. It means there is no omitted part in this investment enterprise, which means we have considered the all cornerstones of the project. Yes. Here, on this part of debt financing, here we always have two things. We always have these two things. We always have two things. We always have two things here. This is what we call issue cost and interest. We need to consider this before. Issue cost and interest. Under interest, there are also two things. Under interest, we have always two things, which are marked loan and the subsidized loan. As I've said, yes, here there is a marked loan or bank loan, and subsidized loan. Now, subsidized loan, it is the loan issued by the government at low interest rate, usually. That is the benefit. While here, under marked loan, when we are just finding the PV of this loan, PV of debt tax shield, we always take this is the formula. We always have a debt multiplied by interest rate, and interest rate, and multiplied by here tax due to tax shield. It is allowable for tax purpose, and after we multiply annuity factor. which is calculated using the interest rate. Yes. Under determination of APV, which is this one, we are going to have NPV, and we add financing effect. The financing effect, first one, PV of debt tax shield on market loan by using this formula I wrote here above. Which is this, and here we are going to add also PV of debt tax shield, PV of debt, DTS, it means the tax shield on subsidized loan, on subsidized loan. Then we, due to subsidization loan and marked loan are different, it means the interest rates are also different. It means here, due to the subsidization, there is a rate of an interest that has been saved by the business, due to it has been subsidized by the government. Instead of paying the higher interest rate on the bank or to the bank, it has saved the reduction in terms of interest rate due to subsidization. It means we need to see the PV of interest saved. PV of interest saved. This interest saved, you always take bank loan minus subsidized loan. Yes. And after that, we see whether in the question they have told that the issue cost will attract tax. If it will attract tax, you need to consider PV of issue cost. PV of issue cost. PV of issue cost is always positive, and there is tax foregone. You less that. Tax foregone. This PV of tax foregone, let me explain it. Then there is also an issue cost on self-T. Yes, this one we deduct on this. Yes, after considering all of them, all of the above together, by taking the NPV plus PV of the tax shield on marked loan on subsidized interest saved, then if issue cost will attract tax benefit, and you add it, then you less tax for bond and the issue cost. Of course, here, due to there is a due to there is a an interest, there is an interest in the business, and the interest is allowable for tax purpose. There is a tax that you should have paid due to lack of debt, and due to you have debt, there is a tax that is shaved or that is waived on your payment. And that tax is what we call tax for a bond. Those are benefits that is that has been implemented to encourage the business to use always a debt. And due to debt is allowable for tax purpose, that's why we need also to consider the tax for one, PV of tax for one. Yes. Then PV official cost, Vianney, I've been saying that under this, you will be instructed on this case and pay attention. If in the question there is a statement saying that issue cost will attract tax, will attract tax. If you attract tax, remember, you will have a PV of the issue cost. You will find the issue cost, and after find the issue cost, and after find the issue cost, and after find the issue cost, you multiply by the present value or the, let me call it discount factor. Discount factor of the first year if it was said if it was said to be initial. At initial, it is always at initial. You will have the interest rate or discount factor. Then you find it is you find its present value, it's PV, it's a present factor, present value, interest factor. That is how. Really, you will be told, you'll be instructed on whether issue cost will attract tax or not. If there is no statement in the question about issue cost, you only list this issue cost. And remember this issue cost always. This issue cost is said to be that you multiply issue cost rate issue rate, then call it issue rate, then you divide 100 minus issue rate. This is the formula of it. And after this, we can find the practical example on how this must be computed. Yes, it was all about summaries of how APV should be calculated. We are going to find a question where we can have all of this together. Let us all of us check on past paper. Okay. Let me find out the past paper. Then I share it with you. Then Mhm. Let me download the past paper. We are going to use, for instance, like, let me say 2022 March. Let me download it. Let me download it then. Past paper. Past papers. Remember, guys, what I've told you in the last session. Remember to extract the data in the question, and after extracting data in the question, remember to determine the relevant data to the question and link it to the case study. After doing that, the question becomes very simple. The question becomes very simple. Yes. I've already downloaded it. See to my download. Is this one? You can confirm whether you are seeing my screen. If it is visible for you, please, before I proceed, confirm. Only Excel. Okay, Francois. Let me have this question then. 2022 question 1. Yes, Prosper, I got you. Let me. Uh, 2021. So 2022. Oh, differ. 2022. April. Question 1. Then then let me hope all of you are seeing it. Let me have it all. Let me have it all. And then let me have it all, and then and then see how we are going to read the question together. And remember, guys, we have a lot. We are going to cover so many things here. And that's why we don't have to waste our time. Whenever you are not getting me, don't let me proceed. Please raise your hand and inform me to come back on where you have lost. Then question 1, 2022 April. Marine Investment Rwanda Limited is a large conglomerate operating in Rwanda, deals in the manufacturing of cement. Before you proceed, remember I told you that come in the requirements and see what is required here. Using adjusted present value and device management of Marine Investment Rwanda, limited on whether they should go on with acquisition of Musanze Steel Rolling Mills Limited. Then compute the purchase cost of Belesh General Hardware Limited, evaluate whether Marine Investment Rwanda Limited should acquire General Hardware advise shareholders before General Hardware Limited as to whether they should accept the merger. Evaluate organic strategy using internal rate of return. Explain to the shareholder of the best. This part 1 is all about APV. This part 2 and part B and part C is all about merger and acquisition. After having an introduction of merger and acquisition, you will be able to do this. And remember, this evaluate organic growth strategy using internal rate of return. Even if it is under merger and acquisition, when it comes to internal growth is all about investment appraisal techniques. Nothing differ. It's almost the same. Using internal rate of return to find out whether the worthiness of the project. Then our main concern is all about APV, and after APV, we'll proceed to the another. We are going to read our question, and through reading, remember you are passing through the requirements, and through reading, you will be able to determine each paragraph, the paragraph, and its responding requirement. If it is internal growth, once you find in the certain paragraph, maybe paragraph 1 or 2 or 3, it is all about acquisition or merging or acquiring. Remember, after that, it will be on merger and acquisition. But when it comes to initial outflows and expected cash flows to be generated in certain period of time, and you find out maybe inflation rate and any other. Then after you find the debt financing effect information, like debt and equity ratio, debt to equity ratio, and you find one industry to another is about to be, they are evaluating one industry to another. They want to shift from one to another, and there is an information of debt and equity. Of course, it will be all about APV due to there is a part of ungeared business which is all about NPV, and there is part of financing. That financing means we combine them together with geared and ungeared to be APV. Then I was leaving here. The company's strategy is to ensure that it maximizes the value of the shareholders. This can be achieved through the expansion strategy that has been one of the main strategies of the company. In the recent board meeting of the company, the board member approved 2 expansion strategies. These include expanding through merger and acquisition or through organic growth. Okay, organic growth, guys, remember, it's all about NPA, investment appraisal techniques. Expansion through merger and acquisition, marine investment. They told here that expansions through merger and acquisitions, Marine Investment Rwanda Limited has identified 2 potential mergers which are considered to be in line with the growth strategy of the company. These include Musanze Steel Rolling Mills Limited, deals in the manufacture of iron bars and iron sheets with a very high potential for growth, since construction is one of the priorities of the government. The current capital structure of Musanze Steel Rolling Mills Limited is composed of 60% debt and 40% equity. The pre-tax cost of debt is 8%, whereas the equity beta is 1.7. Let me first do our data given. Remember, guys, to extract the data, you have only 2.1 minutes per mark. Each mark has 2 minutes. So you have to manage your time by doing so fast as much as you can. Find out whether you will get like minimum 35 on the question 1. And remember, if you have decided to start on section B, make sure that 2 hours is maximum. Maximum is 2 hours. 2 hours is maximum. 1 question must have 1.5. 1 hour and 30 minutes. Yes. 1 hour and 30 minutes. Then we have a cost of debt. We have a debt, capital structure. Remember that capital structure is all about debt and equity. Capital structure. Capital structure. Capital structure. Our capital structure here. Our capital structure. Our capital structure. Capital structure here. Have a debt. Have a debt and equity. Debt and equity here, debt, we have thought that is a 60%, while equity is a 40%. These are the capital structure of Mulindi. Capital structure of Musanze Steel Rolling Mills Limited. Yes. And the pre-tax cost of debt. Pre-tax cost of debt. Pre-tax cost of debt is 8%. It is 8%. It is 8%. Then it is 8%. Then, whereas equity beta, remember guys, equity beta equity beta is symbolized by BE. His equity beta is 1.7. Risk-free rate is 10%. Remember, guys, risk-free rate, if you are not given the subsidized loan rate, use this risk-free rate, because always subsidization of financial support from the government is always risk-free. Market return is a 15%. Then Musanze Steel Loading Mills Limited will MIL Limited will finance the merger by issuing both debt and equity. The expected value of the merger is 500. Expected value of the merger is 500 million. 500 million. $500 million. This will be composed of 350 million bank loan. Out of this 500 million, there is and it is composed by bank loan, and bank loan 350. Yes, 350. Bank loan at annual interest of 12%. At an interest of 12%. At an interest of 12%. At an interest of 12%. Then, and ordinary share capital, and there is also ordinary share capital. Ordinary share capital of 150. Of 150. Sorry. Here of 150. The issue cost on that instrument are 5. Issue cost is 5%. Cost is 5%. 5%. And 5% of the gross amount required of the gross amount. The gross amount required. Of the gross amount required. This gross amount. So the issue cost is the loan is always not net of issue cost. And to find out the gross, you need to find out the issue cost and then you add back on the loan or bank loan. Then the issue was due to the importance of strengthening the construction sector, 40% of the required loan will be acquired at a subsidized interest rate of 8%. Okay? 40%. 40%. This 40% will be subsidized. At an interest rate of 8. At an interest rate of 8%. Then both loans are payable in a period of 5 years. Loan period is 5 years. 5 years. Then the table below, Musanze Steel Law Mills Limited cash flows in Rwandan plants. The cash flows expected cash flows. The number of years we have 1, 2, 3, 4, 5. Then we have 80 million. Yes, then 120. 120, then 180. See here, guys, here they are saving of 3 zeros above. 160. 160, then 195. Yes. Then after this, corporate income tax. Corporate income tax is all. Corporate income tax is 30%. Corporate income tax, it is 30%. And after having this kind of information, due to here, they continue with Belesh General Hardware Limited, Belesh, and is already another case. Belesh. This is all about merger and acquisition. Like this one here. This is all about merger and acquisition. Internal expansion through organic growth. This organic growth, remember guys, I've told you that it is the same as the NPV. There is no change. There's no change as we have considered the effect of inflation and the tax in the cash flow in the last session. The same case here. There's nothing changed. All about organic growth. Organic growth is all about investment appraisal techniques. Let us have It has have this one of APV. Then, as we have discussed from our introduction, here we are going to find out first step, NPV computation. NPV computation. Then NPV computation. Here we have all this information. Since you have all this information, nothing more, nothing much we are required to do here, except that we are going to see, let me call it details, cash flows, let me call periods. Due to cash flows, I want them to be here. Cash flows, period from 0 to 3 years. Here we have an initial cost. Initial cost, it always must be negative, which is this one expected value of the project. And we have the initial cash flows of this amount, and we paste by value here. Then here we are going to less. We are going to less tax. We are going to less tax. We are going to less tax. Tax, of course, it has to be this times 30. And what this 30 will never change. Never change. And we go up to here. Pay attention here, guys. Pay attention here, guys. We have forgotten that we have told it is a free cash flows. It is said to be free cash flows after considering the effect of tax, after you have seen the last session. It is said to be free cash flows after considering all deductions. It is amount available for reinvestment. Free cash flows, there is no impact of tax here. Don't ever confuse. It is a free cash flow. It is a free cash flows. Let me see this question. Free cash flow means what? Enhanced free cash flow means those are the cash flows that are available to business for reinvestment, reinvestment. for investments. Yes, that is free cash flows. Is that to say we will not calculate the tax? Yes, due to the free cash flows, all deductions has been considered already. There's no need. It is a free cash flows, except if they will have said that the pre-tax EBIT, earning before interest and tax. In that case, we need also to less tax. And see here, guys, in this kind of questions, there are 3 marks under working adjustments. Like for, let me work it here. Working. The working number 1. The working number 1, in this case, is all about CAPM, capital asset pricing model. Capital asset pricing model, remember guys, it's always equal to, remember CAPM is the same as cost of ungeared business. Cost of ungeared business. This is what CAPM means. And then it is always equal to risk-free rate plus beta factor risk market portfolio, risk market return portfolio minus risk-free rate. Yes, this is the case. And this our cost of capital, cost of ungeared, is what we call to discount this NPV. Always. This is 3 marks for everyone. Cost of ungeared, it is said to be this one, but here we don't have this beta. Beta, remember, I've told you that it is a level of risk. And level of risk, we don't need to use this cost of this beta equity. Where is it? This beta equity, not. This beta equity is used on the geared business that is using that. Yes, here we need also to find out the beta equity. Beta equity is a beta, or is a debt or level of, it measures the level of ungeared business. It measures the risk of ungeared business. It measures the risk of ungeared business. Okay, beta equity always is equal to cost of value of equity divided by, we take value of equity divided by value of equity plus the value of debt after tax. Then after, remember to multiply, and even multiply it here above, multiply beta equity. This is the formula of, sorry, this is beta asset, not beta equity. Beta asset. Yes, Joseph, thank you very much. This is beta asset. Then here, we are going to have this value of equity. The value of equity is we have been told that it is a 40% times beta equity. Then let me close them like this. Then I divide value of equity Then I divide value of equity plus value of debt times 0.7. This is 0.7 is 1 minus 3, is 1 minus tax, 0.3. This is our beta asset. And after having beta asset, these calculations all about free marks, easy marks, like for everyone. Risk free, well, is risk free? This is 10. This 10 plus beta times risk market minus this risk free. This is said to be this one. Yes, and this one, it is to be used in discounting these free cash flows. Can you please come again on beta asset? Yes. I've been saying that due to we are calculating or we are computing NPV, and NPV is said to be the business which is not using the value of debt. Okay. It is a business which is not using the value of debt. These are the free cash flows. Free cash flows. Yes. Then it is a business which is not using a debt. It means it is a ungeared business. Due to it is an ungeared business, we need to find out the cost of an ungeared business. And the cost of an ungeared business is all about CAPM. We find the cost of an ungeared business by using CAPM, capital asset pricing model, to find out the degree at which the business which is ungeared is operating, is being risky, is being how can I call it? Then let me call it like, we need to have a measure to be used in measuring the level of risk of a ungeared business. And that measure is all about beta asset. Beta asset is the measure of an ungeared business in terms of risk. It shows the level of risk in ungeared. It shows the level of risk of ungeared business, the business which is not using a debt. And you can confirm whether you understood. Discount factor, I think that is 14.1. Let me hope you got it. Yes. On this one, it is equal to, I think you remember that, as I told you, PV is equal to 1 plus interest power negative n. It is the formula we are going to use here. 1 plus interest, which is this one, okay, equal 1 plus interest power negative this one. N amount power 0 is always 1. Don't ever forget that. and this I can close. So that is this, and up to here. Let me have 3 digits. Then PV here. PV here. We are going to take this times sorry. It's all about take this times this one. And of course, it means here is this times this one. This take this times take this times this and this one. Then we have this. Yes. This Ivan I understood, but I was talking about the formula used. Oh, formula beta asset. How is it and yet better when we have seen that the English have the borrowed 350? Ivan, it comes to this once we are determining, we will consider this when we are going to determine the debt tax effect, the impact of obtaining loan in a business. Don't worry. While Emilas, you understand, but you was talking about the formula use, okay? How is it and yet when we have seen that don't worry, this will be considered in the determining the determination of obtaining loan. To easy calculation discount factor, we can use cost rate of yes, it's okay. It's okay. We can use 14. It's okay. Enhance, I've used this formula to calculate beta asset. I'll take value of equity, which is 40%, and I multiply it with beta equity, which is 1.7, and I divide value of equity plus value of debt after tax. Because value always debt is available for tax purpose, we need also to consider the impact of tax on it. Yeah. While Ivan, this is 350. They borrowed. We are going to consider it under debt financing or yes, debt financing effect. Don't worry. It is spread due to they wanted to show us, to instruct us, the level of equity and the level of debt they have. That is, yes. Yes, here we can find base case NPV. Base case NPV. By having all of them together, for this. This is our base case NPV. While Ivan here, please do not confuse it with the 350 they borrowed, because they borrowed, or they showed us the amount of borrowing due to they wanted us to be able to spread, to determine the level of equity and level of debt they had in the expected, in the expected car cost of the project. Out of these three, this 500 million required for the merger. How much do they have as debt, and how much do they have as equity? And we are going to consider that two parts and under determination of debt financing effect. Yes. Of course, now we are going to see debt financing effect. Debt financing effect. Wazna raised his hand, please. Wazna, you can use chat box or Q&A. Please. Yeah. Debt tax effect. Total loan. Total loan borrowed. 350. 350. 350. 350. And they told, out of this 350, sound. Is it the problem for everyone? You're welcome, Melans. Okay, Francois. Here, base case NPV is the same as the usual NPV, the normal one. Yeah. The reason why here under AP we call it base case is that it is the first one we're basing on in finding on determining the effect of obtaining debt in a project. That's why. Yes. Please, Francois. No, Bazina, you can check on your connection so that we can be able to get each other without no hindrance. Okay. Total loan was 350. Let me hope, Ivan, you are with me here. Total loan is a 350. Total loan is 350. Then we have been told that, let us get back the data given. And here, where this discount of 14.1 is from. Francois, is it, we get it from here. We took risk-free rate plus beta, which is beta asset. We have calculated it also here, and we multiply risk market risk portfolio or return market portfolio, then we release risk-free rate, CAPM. By using CAPM formula, there is no any other method. CAPM formula. You're welcome, Francois. Then we continue. We have been told that out of this loan, let me get back to the question. Bank loan at an interest rate of this amount, and then check all this. Issue cost on that instrument are 5% of the gross amount required and will be. We are going to find out the issue cost. Issue cost. Issue cost, I've showed you the formula of it. Where I brought it. It is under here. This is a formula of issue cost. This one. We are going to take this amount of loan, then we multiply by the issue cost, then we divide 100 minus issue cost. Let me have it. And here, it is the same as having this. You can use even 95 by taking 100 minus 5. Then this is issue cost. After getting this issue cost, we can find the gross amount required, or the gross loan required. The gross loan required is about this. This is the gross loan required. This is the gross loan required. After getting this loan required, we have been told that due to the importance of strengthening the construction sector, 40% of the required loan will be acquired at subsidized interest rate of 8. Will be from subsidization. Then it means we are going to take this amount of loan and we multiply it by 40 by 40%. I don't ever forget that. Then we are going to find out subsidization loan, subsidized loan, and here market loan. It is going to be this times 40. Where is 40? This 40 here, and is this one. And sorry, this is subsidized. And in order to have marked loan, I'm going to have this minus. Yeah, we're going to take this and this must be negative. This one, sorry, it is not this. To have negative this plus this one. It is this. And the chat box, issue cost are check your formula, check your calculation. Have you divided 100? Remember to divide 100 because it is in terms of percentage. After dividing 100, then tell me the results. Okay, we can proceed. After getting this, we are going to start on PV of debt, tax, shield. Dear Control Shift, check the calculation whether you are right. I know that. Check your calculation. When do we deduct tax shield from issue cost to get PV of issue cost? Peter, I've said this during the introduction of this. And we deduct tax on issue cost when the question we are told that issue cost will attract tax. Another case, if it is silent, there is no need to consider the impact of tax on it. It is if it has to consider the impact of tax, it will attract tax. It must be in the question. Otherwise, no one will penalize you from not using it. Joseph, please check your calculation. Let me see here. Minus 5 of issue cost, which is this one. Let me check. Maybe I did long. So this times issue cost, which is this one, then you divide 95. It means here, guys, zero point 0.05 0.5, and here 0 point this. Okay, thank you very much. This is the formula. And these are the results. Thank you very much. Okay, thank you very much. Thank you very much. Thank you. Thank you. Yes, here there is one question that how did you get issue cost? Angelique, let me hope you understood. Let me write the formula here. Say to be this loan times 5 out of 95. Yes, this is the formula. Here, I think you remember the formula that on debt tax shield, on marked loan, on marked loan is going to be equal to this times an interest rate of it, which is this one, times tax, which is 30, and it is this one. And is this one. After getting this, we need to find out the PV. I said that we multiply annuity factor as per formula here. I am going to find out. You're welcome, Angelique. Please, all of you make me work for you. The only requirement here, I want you to be active. Then annuity factor. To do 1 minus 1 divided by times 1 plus power n. There are many formula here that you may use to find out the annuity factor. Since our annuity factor is this PV interest factor annuity is said to be 1 divided by the interest rate, which is this one, minus opening bracket 1 divided by the interest rate, which is this one also, and interest rate. Then I multiply 1 plus this interest rate, then I power it by 5. So it will be 4. Yes, this is it. Then PV debt tax shield on market loan is said to be this times is said to be this times this one. Yes, this is the first one. Let me come the question. Come again on PV of debt tax shield on market loan. Dear Tony, here, find out that PV of debt tax shield on market loan. The formula is this one. The formula is this one. The formula is this one. You take debt, which is 221. You multiply it with it. You multiply by its interest rate, which is 12%. And after that, you multiply it with also tax rate. After tax rate, you must have annuity factor. And since it is not given, you have to find it by using the interest rate. This is where it comes from. You're not getting PV of debt tax shield on market loan currently in line with it or more. Okay. This debt tax shield, you know, that debt is always liable for tax purpose. Debt is liable for tax. Is liable for tax purpose. For tax purpose. That's why. That's why it has to be. Always you always consider the impact of tax on it, which means you take debt, then you multiply it with 1 minus tax. Here, be with me, Francois. The debt was this one. And after having this, consider the tax, less with each tax, less tax. By taking this times this, equal this one times this one, which is this. And loan after tax, loan after tax, it is said to be this one, which is negative, you add it, that one. And after this, Francois, this question you may check for us April 20, why they deduct tax shield from issue cost, since the question does not even which costs are they subject to tax or not. Yes, Francois. Yes, Peter. We will go. We go. We check. We will check. We check on it, and I will explain it for you. Don't worry. Then here, remember, Francois, there is an interest. There is an interest. An interest, which is 12 of this. 12 of this, and is this one. Okay? Then let me first do this. Let me first this interest, because an interest is I want to see the benefit. You take this, you multiply it with an interest, which is this one. And this interest is what we have to pay. Okay? And due to it is allowable for tax. It is allowable for tax. This is where we are going to less. We are going to less a tax here. Tax. See the tax effect. Tax effect. By taking this times the tax. The tax. And this effect, we are going to find out the benefit. The benefit, this is the tax. We are supposed, we would have been supposed to pay at each year if there is no debt we are using. And we are going to see the benefit of saving or of using debt. And then we save this 7 million. That's why out of this 7, we are going to find out its value, total amount, its PV after 5 years, from now up to 5 years, which is done here. We are going to find out the present value interest factor annuity of this. And after that, you might be able to see how much are we going to save? Are we much to retain due to using or having a debt? Francois, I think you understood now. Okay, thank you very much. Then let us continue. Then the tax shield, this was 1. The tax shield PV of subsidized of debt of the tax shield on subsidized loan. On subsidized loan. Here, remember, this is equal to this one. Yes. Then here we have an interest on subsidized is interest of subsidized is where is it? This is 40, this is 8%, 8% times this subsidization law. Then after that, let me have tax effect. Tax effect, which is this times 30% of corporate income tax, which is this one. So this times this one is said to be this. Is said to be this amount. And after that, please remember to always use this annuity factor. Each factor you have calculated here above. And of course, this PV subsidized loan will be equal to this one times this. Yes. Which is this third one. Third one, we are going to see the interest saving as we have seen here. The interest, PV of interest saved. PV of interest saved, present value of debt, tax shield on interest saved. Remember, guys, I've told you that T is equal to bank loan minus subsidized loan. Okay? It means the interest here. It means the interest here you are going to take interest here. You want to take 12%. 12% minus 8%, which is interest saved. Which is this one. The amount. Francois, do you have another question? interest saved. Then here, you are going to take, sorry, 12%, 8%, then multiply it with the subsidization loan 147, 360, 368, 368, 421. Yes. After obtaining this, let me take this one times this one. Let me see first this question. Okay, Francois, let us continue. I thought you have a question. So I am going to consider the tax on this interest saved. How much tax effect on an interest saved? Here I'm going to take this times 30%. 30%. Then I need to see here an annuity factor also, which is this one. And after that, PV of debt tax shield or the tax shield on interest saved on interest saving, it is said to be this times this. Sorry guys, maybe I'm wrong here. I misled it with mislead it with tax foregone. Here, there is no need to find out the tax effect. Take this directly times this one without considering that, because this is interest saving, there is no an issue of tax here due to it is an interest saving. It is an interest that should have been paid to the bank, but was saved in the business due to obtaining the government support. Let us go for this form, which is tax foregone, PV of debt tax shield, this debt tax shield, this debt tax shield, this debt tax shield, this debt tax shield from tax foregone. Tax foregone. Tax foregone, it is resulted by the subsidization that government has gave to the business. If governments have decided to sponsor to support the business, already there is a tax they should have been expecting from the business, and they forgone it through subsidization they give to the business. Without subsidization, of course, this tax must be paid. And due to the subsidization, the tax not be paid to the government. Yes, that's why we are going to see the tax government should have been expecting from the business, and due to they decide to support them, they forgone it. They decide to lose it. They lose it. Okay, interest saved. Interest saved. Interest saved. Interest saved. It is this one. And tax forgone. Tax on interest saved, which is tax forgone. Tax forgone is said to be this one times 30, which is the same as that one I did above. Then here we are going to see PV of tax forgone. PV of tax forgone, we need to have this unit factor, which is this one. And after that, PV of tax forgone, which is said to be this times this one. This one times this. Yes, it is this one. And after that, I think you still remember that we have initial cost. Initial cost, which is going to be this one, which is, yes, not. Initial cost is 18. Is 18. Before I proceed, I've seen some question come. Why do we apply for? Yes, Joseph. Of course, we apply it on subsidized loan due to it is the one which permitted us to save that interest. Hey, because there is no interest we have been saving from using the debt. Bank cannot waive any rate, any portion of percentage of on the interest we paid. But due to there is government support that has readers, that has supported, that has facilitated us to save the interest we were supposed to pay to the bank. That's why we applied the 4%, this 4% to the subsidization loan. It was because it is the one which we saved on it an interest. Don't confuse it with the bank loan. Bank loan, there is no waive. Yeah, there is no reduction in interest. But due to government support, you've been able to save some interest. That's why. Then here we can be able to compute our APV. Compute our APV. by taking the base case NPV, which is this one, and we take this marked loan, subsidized, and interest saving, and tax foregone, and issue cost. Marked loan, we have this 28, and subsidization, we have this 12, and interest saving, we have this tax foregone. Remember, tax foregone is a negative. Tax foregone is this one, and issue cost is a negative, which is this one. And after adding all of them together, yes, this is our APV. This is our APV. Let us come back here. See here, based on the data, given above, the project should not be accepted. Project should not be accepted. Due to our NPV is 0. Sorry, is negative. Is negative. You see, this is where we will stop it on deciding basing on the NPV. But see, come here and see here. Our APV, after considering the impact of obtaining debt, is a positive based on the APV found. We found the project should be accepted since our APV is positive. As I told you in the introduction of this one, if possible, show us data on question 1, December 2023. Yes, I'm going to let us also let me download it. Then after it, we will be able to proceed. Those who have a question on this, please. Meanwhile, I'm going to download December 2023, and we extracted the data in the question. Please, you can write your questions on this under chat box or channel. Remember, guys, those who have a question on that case, please write them in the chat box. and I am downloading the 2023. Okay, let me see. Guys, remember I am going to this was yes, November 2023. November 2023. Guys, this is the question. This was the question. It was a very, very easy. It was a very easy question, but tricky one. So let us always together read the question, but let me see those who have a question. Are we getting those notes afterwards? Yes, Bosco. Don't worry. Can we see the last figure just move down little? Oh, sorry. The last figure, which is this one? Okay. Oh, can we say, okay? Let us continue. Thank you very much. I've been saying that we are going to read together this one. Question one. Hmm. Peter, this is the case. It is a 2023 April. Hey, April. Okay. This is for November. Sorry. We will check it. Don't worry. Yeah. We are going to extract the data from this. And directly we jump to April 2023. Okay? Don't worry. Eastern Power Limited is a hydroelectric power plant with an impoundment facility. The company has established a project to build a hydroelectric power plant in Bugesera. The company intends to purchase an initial classroom machinery for 100 million. Oh. That's a given. Yes. Let us first read the requirements. Using appropriate calculation estimate adjusted present value of that company proposed investment. Differentiate between APV and NPV as method of investment appraisal indicate the circumstances under which APV might be a better at evaluating a capital investment than NAPV. Then using information, using information in the World Investment Limited case above, calculate financial ratios for each of the three subsidiaries. Then note, use ratios or multiples in table 2 only. Okay. Describe these three companies from the financial point of view based on the answer found above. Then identify the ethical issues reported in Alaga Limited and the likely impact on these issues on the company if not addressed effectively. Okay. After reading the requirements, please, please remember that I told you, attempt the easiest part of the question. Under this, there are some theorems which not required to calculate any. This does not require some calculation, some practice, like this differentiation between APV and NPV. These 5 marks you can even get them within 3 minutes. It's all about importance of APV, Danny. You explain what APV mean and NPV mean, and after you give the importance of APV than NPV. Remember, I told you that you have to read the question carefully, see the verb used, and see and after seeing the verb, then find out how are you going to tackle that. Then after finding this 5 marks was really free, was really for free, and even this ratio you already have a, and under book there are all formulas of ratios you are required to do here. Okay, what you are required is all about interpretation of the ratio or the formula you find in the book. It's all about its interpretation. And even here, you can come here very quickly and you read this small paragraph. Then you may find there the ethical issues, not professional ethics of conduct. The opposite. What's in the what's the what is the what are included? What are points included in the in these 2 paragraphs, which are not ethical? Even these 9 marks and these 5 marks, you can even get them 14 marks in less than 14 minutes. And these 15 marks on the ratio, you may even find some very easiest interpretable ratios. And after consulting that, you come back on the APV. That's how you have to allocate the available time to the available marks. Let us read. But give me 1 minute, guys. Okay, I'm back. I'm back. Questions here. What is the reference of this question? Ivan, come again, come again. What do you mean here? Yes, Peter. Okay. This is November 2023. Let us go together. Here, Eastern Power Limited is a hydroelectric power plant with an impoundment facility. The company has established a project to build a hydroelectric power plant in Bugesera. The company intends to purchase an initial crucial machineries for 100 million. Here, initial, this is the purchase cost. Purchase cost, which is 100 million. Yes. Yes. 100 million. Then the machine is expected to operate for 25 years. This is useful life. This is useful life, 25 years. No, Ivan, we are not going to attempt it in full. No, we are going to deal with this part of with this part of APV. No, I will not go for a ratio. Except any one of you doesn't know how to interpret the ratio. That is a very important thing on the ratio, nothing more than big. Useful life, and get free depreciated. After 25 years, the residual value will be 0. Then Eastern Power Limited predicts that it will earning before interest and tax and depreciation amount. So yes, earning before interest and tax depreciation amount said to be 14 million. And then $14 million. Yes. Then per annum for 25 years. And with the effect from the end of the year first. Yes. The company pays corporate tax rate of 30%. Corporate tax rate was 30%. Tax rate 30%. Then the company's investors require 12% rate of return. 12% rate of return. Yes. 12% rate of return. Then the investor's rate of return. This is a cost of capital. or cost of equity, 12%. 12%. Then, under project, under the all equity financing, okay, under equity financing, these 12 is already given. It is not the same case of the question above, which we used CAPM to find it, calculate it, while it is given. Yes, I mean, I think it is for APV, not word question. Not word question. It is all about APV. I told you that we can't find time to tackle a question on ratio, because the ratio is the very easiest part. Ratio, it is 3 marks for everyone. It's like a bonus. When it comes to the exam expects all of you to pass. No one is supposed to fail once there is a ratio in the exam. What you are required is only interpretation. Because I told you that the big portion of the marks on the questioning, on the ratio question, is all about interpretation. Once you don't know how to interpret ratio, I don't know if you can be able to get even a half of the marks. No, you can't. But firstly, focus on interpretation of the ratio, because the examiner, he or she has already know that you will be using a reading box, and she or he can't give you a ratio which you will not find in the book. What he or she wanted you to show him or her is that you know the operation, the purpose, the main purpose of any kind of ratio, which is interpretation. Yeah, let us go. Pre-tax cost of debt. Pre-tax cost of debt is 9.5. Is 9.5. Then, because the extent of grid electricity is limited and mainly concentrated near the capital city, the government will subsidize the project with 50 million subsidization from the government. Subsidization is just 50 million. Yes, 25-year loan at an interest rate of 6 per year. Useful life alone. For loan is 20 years. Yes. Then useful life loan, 20 years at an interest rate of 6%. Then to expand capacity and meet its national strategic plan, the government has allowed the company to repay principal in a single payment. In a single payment at the end of the loan duration. This is the question. And we are required here under requirement 1, using appropriate calculation, estimate the adjusted present value of that one. Remember, guys, we are going to correct this, and after Mr. Peter wanted us to pass through question E1 April 2023. Okay, we are going to use a few minutes on it, then later we go. Okay, remember guys, our steps is all about NPV. And due to we are not given the capital structure, we are not required to find out the beta asset or beta asset. This is not it, but we are given straight information. Then, one, base case NPV. Remember, we have 20 years. We have 20 years old, 25 years useful life. Let me first find out depreciation. Depreciation, you find the easiest part where you can find easy marks within short period of time. And of course, depreciation is the one. You know that depreciation is always equal to cost of the asset minus residual value divided by useful life. This is the formula. Is the formula. It is said here that this one divided by 25 due to residual value is 0, which is 400 or 4 million. 4 million. It is a depreciation. And after this, remember, this must be depreciation. This is our depreciation. It is a first information. Yeah. You know that we have this earning before interest and tax, which is 14 million. Then we are going to less tax. After listing tax on this, I have this times tax rate, which is this, and earning after tax, it is said to be this, and this. It is this one, but I need to add back depreciation. Add back depreciation, which is this, and this must be cash flows, and this must be this plus this plus this one. This is the first First way. Second way here. The second way here. The second way here is when you will be having this one separately by finding out the depreciation tax shield, depreciation tax shield, depreciation tax shield by taking this times 30%. Yes, which is this one. This must be added back here. This must be earning after tax. Yes, Joseph, I got you. That's why I've decided the first way and the second way. You take this, then you less. Information are the same. Less depreciation here, which is this one. You find EA and before tax, which is this. Which is this one and this. Then once guys, let me hope why we less tax before. Of course, Piani, depreciation is non-cash expense, non-cash item. That's why it has to be deducted in the profit before we apply tax. That's why. Then here we less tax. We less tax. This times 30, which is that one, and EAT must be this one, this minus this and this. Yes, then we add back depreciation. Sorry. Add back depreciation. Add back depreciation. 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 Which is 4 million. And we get cash flow. Cash flows which is said to be this plus this one. And here I'll add back the deep tax shield. Deep tax shield, which is this one. And first cash flows to be discounted. Cash flows to be discounted. Be discounted will be this plus this one. Be discounted. Mistake here, guys. Here, there is a mistake here, guys. Take this minus this and this one. Yes. Then here, take this plus yes. Then you can find here, you can discount, and after discounting, you will use 25 years at this 12. And after that, you see whether your NPV is going to be positive or negative. And after that, let us do it. PV, interest factor annuity at 12%. I think you already know or you remember the formula. Minus 1 divided by rate times 1 plus power over 25. Yes, this is the discount lay. Once I find the PV of the machine, after 25 years, it is said to be this one times this one. Then I'm going to find out the NPV. NPV here, base case, which is base case. Base case NPV. It is going to be this one minus initial investment auto discounted yes which is this one. Yes, which is this one. While financing part, this is a financing effect. Financing effect. There is a debt. There is a debt which is financed by the government, and another will be, of course, from the market loan. Why is base case NPV negative? Yes, base case NPV is negative because cash expected cyangwa discounted discounted cash flows are lesser than the initial investment. You know that we always take total discounted cash inflows minus total discounted cash outflows. That's why. Yeah, I was saying that under financing effect, we have a debt. There is no issue. Cost marked the value of loan. Here we have marked loan. We have marked loan. And this marked loan, we have thought that the pre-tax cost under equity financing project because the external blah 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 blah. Stabilization with the 6. Here, 50 million. And under this 50 million, I've been told that nothing much. We need to do with it except interest. Remember, interest was before pre-tax. Interest was pre-tax, which is pre-tax 9.5%, which means this interest after tax must be this times 1 negative 30%. 30%, which is this one. Times 1 negative, well, is the third term, which is this one. Yes, which means what interest amount to discount or before doing this, you can even take an interest pre-tax. Yes. Then we have PV, debt, tax shield, on. On marked loan, which is going to be the same case times this one times, we can even do this after tax 1 negative 30. It is an interest of 1 million times yes. Check for me whether here. Oh, there is an information missing, maybe due to we have 20 and we have a okay. Then here our loan period is for 20 years, for 20 years, and let me check this thing whether 9.5 times 0.7, whether it is matching this times this divided by 100. Then after this, sorry, after this times okay, let us continue, guys. Then here, annuity factor, PV, interest factor, annuity, PV interest factor, annuity. PV interest factor annuity. If 50 million was subsidized loan, how was the other financed? Joseph, this is what I am going to do here. Out of 150 will be subsidization. Of course, another 50 will be subsidized. And they told that it is on interest of 9.5. Pre-tax cost of debt. Yes. Pre-tax cost of debt. Yeah. It is for 20 years, 9.5%. Then here, based on the formula, 1 divided by 9.5 minus 1 divided by this one times 1 plus this power 20. Yes, 20. This is PV or data sheet on marked loan, which is going to be this times this times this one. It's going to be like that one. Why discount tax saving on marked loan interest by using cost of debt, not use interest rate of 6 of marked loan, as you did in the previous question. Okay, let me show you guys. Look at here. The government will subsidize the project with 50 million. The 20-year interest rate, 20-year Oh, sorry. I didn't see that there is a comma here. I thought this 6 was on this 50 million of subsidizations. Yeah. Okay. Thank you very much. Thank you very much, dear. It means that here we are having 6%. Yes. We are having 6%. And if we are having 6% here, and we are told that 20-year loan at an interest rate of 6% per year to expand capacity and meet its national strategic plan. Yes. Thank you very much. I didn't see this comma here. I thought it is on this 50 million government support. Then here it has to be on this 9 cost of debt, not interest. You have to change. I'm going to 1 divided by this one minus 1 divided by this one times 1 plus this one power 20. Yes, this is the present value for marked loan. Then after that, we are told that we don't have a risk-free. We don't have a risk-free rate. Since we don't have a risk-free rate, but what was marked loan, not subsidized. Thank you very much, Joseph. Yes, it is right. It is for marked loan. There is no rate for subsidization, which means we don't need to find out the subsidization PV. And we are told that the government has allowed the company to repay the principal in the single payment at the end of the loan. If they are allowed, they give them this incentive. It means that we are going to find out the PV of this financing at the end of 20 years. Principal prepayment PV of principal prepayment after 20 years. After 20 years, 9.5%. It means I have already given this 50. We are going to find out discount factor. We are going to find this discount factor. Discount factor is going to be 1 plus 9.5. Where is that? Yes. Power negative 20, which is this one. And come again, how you get to take this 50 million times 6%, only that. Then this one will be equal to 50 times will be this times the 50, which is this one, which is this one, which is this one, and this is our NCAS NPV, base case NPV. And since we have this, our APV, and there is no rate for this loan, and there is no issue cost. It means that this debt is not on itself. It is this incentive of principal prepayment at the end of 20 years. It comes in due to government allows them to do so. Yes, that's why. And after taking our base case NPV and the PV of our market loan and the PV of prepayment. Then our base case is equal to this amount and this one equal to this and this equal to this one. Our APV is going to be equal to summation of this, which is 12 million. Yes, this is the case here. Then directly let me see the time going, the time launching, guys. Let us lead in the April 2023, and then we proceed. Don't we change pre-cost of debt to post-tax to post-tax of cost of debt in the case of deducting debt, discounting debt, in the cost of discounting debt. You're confused there. Can you open Microsoft microphone for us to ask question? Joseph, I don't know if I'm allowed to. What kind of this APV? It is how, yes, this is how it is. It is depends on the data given. Dear Joseph, I'm not allowed to allow you to give you the floor to. Then mute yourself and talk and ask. Please, unmute yourself and ask. Turahir what Siri? This 20, this one. Guys, once we take this times this, this and this, and what that one, and once I take this, let me show every one of you where it comes from, and yes, we proceed. What about the second part of the question one to the first part? Which one, Francois? Let me first show this. Look. Here on this, there is an impact of tax. It is after tax. Okay, it is after tax. After this take this 50, then I multiply by this interest, then you multiply even 1 minus 30%. This is where it comes from. Then Francois, which part from table 1 below? Table 1 below. Which table? Which table, guys? This for ratio. This for ratio. Check. This for ratio. Even this one. We have 3 scenarios here. This one for instant power for Burera, and another one for Maroga Limited. Yes. I can see Francois and the yes, Francois, they are for ratio. We have three scenarios here. Then, guys, we are going to read the question for Peter. Let me see if let me download it. Why do you use 6 of interest on marked loan? Yes, I've used the 6% of interest on marked loan because see here, guys. Oh, they are told that here there is a comma here, 20-year loan at an interest of 6% per year. Look at this one. Yes, we can now close it, I think. I hope so. We are Joseph. Why in question 1 to find that you multiply by 30 and for this use? The reason why is because we are told that it is a pre-tax. It is a for pre-tax. If it is a pre-tax, we need to find after tax. And after tax is all about to take the cost, of that, and then we multiply it with one negative tax, which is 30. 6 is for subsidy. Joseph, there is a comma here. There's a comma here. And after this comma, there is a statement, 20-year loan at an interest rate of 6 per year. Peter, the reason why we use the 6, we use the 9.5, not instead of using this 6, is because we are given the interest and the cost of debt at the same time. If you are given an interest rate and cost of debt, of course, cost of debt becomes the rate to be used in discounting. And if we are not given the cost of debt, of course, the interest rate becomes cost of debt at the same time. Present value of principal prepayment. Present value of principal prepayment. Look, it is at the end of 20 years. It is the present value of 9%, 9.5% at the end of 20 years. This is the formula used here. 1 plus 9.5% power 20. Power 20. Peter, this is the formula used. Guys, time is lunching. Time is lunching. Let us let us continue. April 2020. Let me download it. Peter, I didn't use the interest rate. No, it is a cost of debt. Check. Yes, Vianney, I know. Peter, I used the cost of debt, which is 9.5. Yes, this is that one for April 2023. Based on this information, And Peter, your question was all about they deducted PV. They deduct PV on the issue cost. There's nothing complicated here, except that, except that when you are given a question which has The farms industry instead of farm is a equity ratio, average equity beta, and let me tell you how to do this. Only this, and Peter, there's no one who will penalize you from not using the PV of issue cost once when the question it is silent. No one will penalize you except when they have said that the issue cost will attract tax allowed. In that case, if you get a confusion in the exam, if you meet in the case like this, and you find the issue cost, there is no information about tax on it. Okay? There is no information about tax on it. There is no benefit you need to find here. Except you create an assumption. Please put an assumption and say, I am suppose that the issue cost will attract tax benefit. Only that. Here, the TCL has an equity beta of 1.9 ratio through the change because a new investment. Guys, if there is an information of old investment and the new one, please consider the information for new investment, which is this one. From the same industry have an average equity beta of this one, and the average rate to equity rate of this one. The risk-free rate is this one, and blah, 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 blah. Nothing complicated here. Peter, don't have an issue on that. Don't be stuck on that one. Except that they told you to use an assumption. Please put an assumption and say, let me suppose as an assumption, I suppose to use each cost as tax attraction. It will attract tax benefit. Only that as assumption. Or put that assumption that I assumed to not using tax benefit or issue cost. There is no one will penalize you, will not give you marks. Don't worry. Let us continue, guys. We still have a lot. This is business valuation. Business valuation. It is a very, very, very interesting part. Merger and acquisition. Business valuation. Business valuation. Merger and acquisition. Guys, under business valuation, this is a period when one business wants to acquire another business, want to merge another business with another business. They need to see how much are we going to pay based on the value they have. You will need to find out the value of the business of acquiree in order to find whether your acquisition or margin will not put you in the loss. To check whether the acquisition process is profitable, you need to check whether the value you want to pay for another business you want to acquire is below than the value of that business. That's why in many cases you will be asked to advise certain board management, to advise board management of a certain company on whether they proceed to acquire or not. It will be based on the value of the acquiree. Yes. Here we are not going to go through organic growth due to it is already covered under investment appraisal, but we are going to tackle a question which contains business valuation and merger and acquisition through maybe price earning ratio, price earning ratio, cash flows, and any other method of valuation. Let us have one past paper. Let me check. Let us have I am just downloading 2021 December question 1, and it is oh, no black time. Francois, do you want black? Okay, let me project this question, then we have 5 or 10 minutes black. Let me project. Let me project it, then some of you yes, December 2021. December 2021. It is a long question, but interesting. Okay, before Blake, let us all of us together read the requirements. Then during your black time, you have to think about it. Then you are Mrs. Motoni, and you are required to compute the value of equity of Akanoze Limited and of Kabori Limited before the acquisition and of the combined company after the acquisition. Based on the equity value created after acquisition, advise whether the acquisition is worthwhile. 25 marks. Assuming you are a member of Mrs. Motoni's team, assuming the percentage of cost of loan notes is the same as the one of long-term debts. Compute the after-tax weighted average cost of capital of a case limited on the market value basis. I think you already able to get these 17 marks on Wachacha. Explain to the Akize Limited management team the following method which take into account risk and uncertainty while making investment appraisal. Among these, risk-adjusted discount rate and simulation. This simulation, it allows more than one variable to change that themselves. This risk-adjusted discount rate is when you take the discount rate and you consider the margin rate or marginal rate. Explain the case management team for 4 practical considerations which the team must take into these 8 marks is very easily, and this Wachacha. Then we will come to this 25. Okay, this is your time, guys, for 8:37, and let me hope all of you to be around at 8:45. This 8-minute break. Okay, guys, we are back. We are back. We are back. Oh, we are back. We are back. It is almost 8:47. Let us rush. Okay, let me hope all of you are getting me well. Anyone can confirm through the box chat. Okay, let's go. This is 2021, December question 1. Umez Investment Company is holding an investment firm with sizable portfolio of companies that are separately and independently managed. Okay, let me hope all of you are getting me well. And on quarterly basis, Ms. Motoni, a portfolio manager, together with her team, review pending decision among the portfolio companies and technically support company management to make final decisions. Then, company 1, we have Akanos Limited. That are given. We are rushing, guys. Akanos, sorry, data given. This is for one company, which is called Akanos Limited. Akanos Limited. Yes. Anyone who is not seeing my screen? Okay. The board of directors of Akanos Limited has shown its interest to grow through acquisition of other potential companies in the same sector. Akanos want to acquire some another companies from the same sector, with the same in the same sector, which are in the same sector. The board has already identified Kabori Limited as a target company to acquire. This is the acquirer. This is the acquirer. This is the acquirer. Then here, Kabole Limited is acquiree or target. Guys, be with me. This is very serious question, and it is mostly likely to come with more marks. While Akanos Limited has 30 million shares in issue, okay, number of shares. Let me call details. Number of shares. Then after that, number of shares, 30. Let me save 3 zeros here. There's no need. 30 million. $30 million. $30 million shares in issue. and currently trading. Currently trading. This is market price. Market price of 250. Market price of 250. And Kabore Limited has only 4.6 million, which means this is 4 million and 600. Yeah, Francois, this is 2021 December. Guys, ndabinginze tubane kuri ibi bintu. Ibi bibazo byo kuri investment appraisal na merger and acquisition biza bifite amanota menshi cyane. That's why I want all of you to be attentive and active on this. Yes, and its debt are fair valued, which is market price 740. Sorry. This is not market price. It's not market price. Any issue, and it's debt. This is the value of debt. Value of debt of Kabore, which is 740 million. Okay, then while Akano's Limited, Kabore Limited is a profitable company that is recently made EBIT or PBIT, which is profit before interest and tax, 195 million. Yes, 195 million. Then this was after removing non-cash expense, which included the tax allowable depreciation. This is depreciation. This depreciation of This is depreciation of 26 million. 26 million. And Kabore Limited makes annual cash investment in asset and working capital. This is working capital management. Working capital investment. Investments, which is 23 million. Which is 23 million. Kabore Limited expected that cash flow will continue to grow. Growth rate 5%. 5% higher, and cost of capital here, which is cost of capital which is what is said to be 13%. Fresh. You have to add 3 zeros on value of that. Okay, thank you. Thank you very much. And those 3 zeros must be there. Yes. Thank you very much. Should Akanos Limited succeed in acquiring Kabori Limited, the combined company's sales will be combined company's sales will be 9. Combined company sales. Combined company sales. Let me write here combined. Combined sales will be 520. Yes. Then, in the first year, and sales, with the sales expected to grow by 6 annually for the next 3 years. And we are told that, and sales is expected to grow at 6%, in the next 3 years. The next 3 years. Then annual pre-tax profit margin. Annual pre-tax profit. Pre-tax profit margin is a 17%. 17%. Then, for the next few years ahead, then it is planned that the combined company will require additional investment additional investment or the combined company, which is 62 million. 62 million. In the first year, then sales will increase, and in the first year, and is said to be increasing by 15 for every 100, for every 100 increase in the sales. Yes, the increase in the 100 increase in sales will also increase 15 on additional investment, which is working capital. Then the combined annual depreciation will be equivalent to the investment required to maintain the company at current operational level. There is not any depreciation. It will remain at 26. After the first 4 years, the combined company's free cash flows will grow by 3%. After 4 years, combined companies cash flow will grow at 5%. Yes. Then later, sorry, not 5, it is a 3%. 3% annually for foreseeable future, while its cost of capital will be 11 after combination. Cost of capital will be 11%. Then, after the acquisition, the capital structure 3 capital structure. Yes, capital structure. Capital structure is going to be 30 to 70. Yes. Cost of capital, saying that it is 30, 70. Debt to what? Debt to debt to equity level. Debt in the market, which means debt is the 30% and the equity is the 70%. Yes. Let us continue. Then we are told that applicable annual tax rate. Tax rate is the 30%. Tax rate is the 30%. And then case limited. These are about Wachacha. These are information we have on Akanoze and Kabore. This is the data given here. Okay, we are now about to start. Yes. Here, under Akanoze, we are given this information. The given number of shares and market price of shares. We can be able to find value of equity, value of business, value of equity of Akanoze by taking number of shares times market price of share. Market price of share, which means value of equity value of equity is going to be equal to this one times this. This one is going to be this. It is said to be this. Then the value of Kabore, value of equity of Kabore, value of equity of Kabore, value of equity of Kabore. You remember that we have this PBIT and we have this working capital. Let me do this here. we have this PBIT, profit before interest and tax. Then following less tax, which is this one times 30% of tax. Well, it's tax rate. It is this one. This is 30%, not 0. This must be negative. This must be negative. Then it is profit after tax. Then of profit after tax, we need to add back depreciation, which is this one, 26, and remember to less working capital, which is this one is negative. It's negative. Then after that, we get free cash flows. After this, it is the free cash flows. The free cash flows, which is this plus this minus this one. Sorry, I made a mistake here by adding this is a free cash flow. This is our free cash flow. Then when we have a free cash flows, you remember that we are told that under this, and Kabore Limited expect that cash flow will continue to grow at a rate of 5 per year, which means when they told that grow at rate per year, we continue expect to grow at, which means here it's like terminal value rate. Terminal value rate, and you remember that terminal value is said to be cash flows of the last year. Cash flow, let me say this, cash flow, then 1 plus growth divided by cost of equity minus growth. Is how to find out cost of terminal value. Then terminal value here, it is equal to this amount times 1 plus growth, which is 5, and I divide the cost of equity, which is wachacha, of this one minus this one. Understanding the questions. Which paper is this? They all, yes, they are all correct. Yeah. The terminal value, this one, the value at, this is the value, this is the value of Kabore after considering the impact of inflation. Impact of inflation. Yes. Kabore after considering the impact of inflation. Yes, this is the value. Then you know that Kabore have there is a date in the Kabore of how much of this amount, value of debt, yes, less the value of debt, less the value of debt, which is this one, and of course it has been negative, which means the value of equity of Kabore is said to be this one. Anyone lost? We are together, all of you. Thank you very much. Then they are told that another information we have done by our first category. Let me call it first step of finding determination. Determination of values of value of the company. Determination of value of the company. Yes. Then present value, second part. The value, the combined company, or the combined company. Then, under this information, we are told that sales is expected to grow at this one. The combined company's growth is this one in the first year. It means particulars, another particulars will have a number of years, 2, 3, and 4. Due to have many 4 years. And here it is a combined sales. Particulars on combined company. combine the company. On combine the company, we have sales here. Have a sales, and after this sales is this one, sales this one, and they told that sales to grow at 6 for every year, which means it is going to be this times 1 plus this. Yes. Then take this times 1 plus 6. This one, and here it is said to be this one times 1, 6. Yes. After having the sales, the next information is that we are told annual pre-tax profit margin. Annual pre-tax profit margin. Annual pre-tax profit margin. Annual pre-tax profit margin, it means annual pre-tax profit margin. Annual pre-tax profit margin, which is this one. And is said to be 17. 17, yes. Which means I want to take this and take this and then multiply it by this 17. Yes. Up to here. Yes, after this, due to it is annual pre-tax profit, which means it's like earning before interest and tax, we need to less here tax. Tax at 30%. Which means it is this times this times 30, which is this one. Yes, it's said to be negative. Said to be negative. And has to come after up to here. Then profit after tax. Profit after tax. Annual after tax profit. Then correct profit after tax. It is this one, this minus this one, and to scroll light. Sorry, I made a mistake. Instead of deducting, I add. Yes, after getting this profit after tax, we are told that after getting here, we are here now. It is planned that the combined company will require additional investment capital of 62 million. Additional investment capital, additional investment. Additional investment is this one in the first year. And they thought in the first year, and is said to be increasing by 15 for every 100 increase in the sales. Okay, where they say that in the first year, and 15 100 francs for every 100 increase in sales for each of the next 3 years. Yes. Here, I need to find out the increase in sales. Here, due to that I don't have increase in sales, let me call it working adjustment. Adjustments. Increase in sales. Yes. Increase in sales, we have increase in sales, we have this. Let me copy all of this and paste all of them here. This is sales. This is sales. Increase in sales. Increase. Increment. There's no increment here due to it's near 1. There's no increment here. While here, we need to take this minus this one. And here, we need to take this minus this one. And here, we take this one minus this one. This is an increase in sales. Why there is an increase in sales? We are going to find the increase in the working capital. Increase in the working capital. Adjustment. Investment. Then, due to we are told that in the first year, there is we have 62 million, which is this. And under here, we are told that we need 15 out of 100. Have 15 out of 100, which means this times this divided by 100. Let me close them. Yes. up to here. Yes, these are the increments in working capital. I hope everyone is able to see how get this increment. Let me write a formula. It is all about increase in sales, increase in the sales multiplied by 15 out of 100 of increase of sales is the formula. Yes. Due to it is additional investment, additional investment means there is a cash paid out to increase the investment. There's a cash paid out to increase the investment. Cash paid out to increase the investment. Yes. After this, we can be able to get our free cash flows to be discounted. Let me check if there is another information. Yes, there is another information here, but let me first find free cash flow to be discounted. Be discounted, which is said to be earning after tax. Then we minus this one. Same. Yes. Then under this information here, they are told that after the first 4 years, the combined company's free cash flows will grow by 3% annually for the foreseeable future. After 4 years, here we need also to find out the terminal value. The terminal value, but the terminal value here must be added to these last years, or we discount and then we find out the terminal value later and we add the present value together. Discount factor is found factor at 11%, which is this one. Here, the formula is the same. 1 plus interest power negative n. Here, 1 plus 11 power 1. Sorry, not power 1, power negative 1. Power negative 1. And let's go right up to here. Up to here. Yes. Then here PV, present value, present value is said to be this times this one, and we scroll right up to here. Then after this, we need to find out total present value, total present value, see whether the present value is this one. To present value, it is this one. Then yes, here we need to find terminal value. Terminal value, remember, you take free cash flow, terminal value, under here, you take free cash flows of last year, then you multiply 1 plus growth, you divide cost of equity minus growth. This is the value for terminal value. Then my terminal value here is going to be, it will grow by 3% for perpetuity under here after combination, after the acquisition. Oh, yes, then it is equal to free cash flows of the last year is this one. Then I multiply 1 plus growth, which is a 3, which is a 3 of this one. I divide cost of equity, which is 11, minus 3. It is this one. Then after this is the terminal value, the value of the business after combination, after 4 years, in the value. Let me first find PV of terminal value. I think you know that I have to take, let me write a formula here. Formula terminal value here. Take 1 plus growth, sorry, cost of capital power negative n of last year. Here, going to take 1 plus 11 1 plus 11 1 1 plus 11, which is this one. Then I divide, I power -4, which is this one, which is this one. Okay. Geraldine, we wish you give us the equal and Excel sheet for the division. The internet was not okay for me. I'm lost. Don't worry, Geraldine. This Excel sheet has to be shared with all of you with this record. Yes, then here, PV of terminal value will be equal to this times this one. These are 10. Then, after getting this, I need to find out total equity of combined. Here I need to find out total value of combined company. Capital of combined company, I have to take this plus this one. This is the value of combined company. Yes. Then let me see another question here. Okay. And we are told that, let me see another information remaining on this. We are told that the capital structure 30 to 70, value of debt is 30% and value of equity is 70%, which means capital structure we have a debt and we have equity, where here had 30%, here we had 70. This is, and this one. Okay. Then after this, value of equity, value of equity it will be found out of this combined 70%. Value of equity means value of combined company times value of combined company times value times cost of equity times the value of equity times equity. times equity. Then here, it is said to be this times this one, which is this. And the value of the company before acquisition or merge, we can be able to see the the value of Akanos before acquisition. Look, old match. The value of equity was normally 7, and that one, while here, did this one. On this one, let us see whether there is a value of equity. Value of equity after merge or acquisition. Then value of company value of equity before merge or acquisition we have to add all of them together. Kabore, value of equity of Kabore, value of equity of Kabore, of Akanoze, value of equity of Akanoze, value of equity of Akanoze, value of equity of Akanoze was said to be this, and value of equity of Kabore was said to be this, and the value of equity after merge, I'm going to add all of them together. Take this plus this one to get this. And there's a question here. While solving this, are we using asset-based mode or market-based or cash flow? Here, I'm not using asset-based, no. I am using here market-based and cash flows. Yes. And normally, if you are given a question based on that require you to assess the merger and acquisition, and then your device based on asset-based. The main concern is the adjustment, and those adjustment is all about devaluation and devaluation. And after considering that, check whether on tangible asset they told it is on fair value. If it is not on fair value, remember to exclude it from the total asset. Then you deduct current liability to retain or to remain with your net equity or net asset. Yeah. Then here is the value of the merger after, sorry, before, and this is the value of merger after of the company after acquisition and the merger or merger. You see here, since the value we are required to ask whether they should acquisition, whether the acquisition created value after, yes, based on the equity value created after acquisition. When we are here, we are done with every details given. Let us solve as since we are going to see whether there is a value creation. We will be having value creation by taking value. This is the form by formula. And I paste it here. Then minus this one. This is the formula. This is the formula. Once we get, if we get negative, there is no value created. If we get positive, there is value created. It means then it's okay. I will be back on it. Then here, we are going to take this minus this. Okay, since we get a positive here of 1 billion, it means the acquisition is worthwhile. Let me use capital rate out. Acquisition is worthwhile. The acquisition is worthwhile. The acquisition is worthwhile. Means accounts should go ahead for the acquiring Kabore. Hilton, it will increase their value. Yes. Then you are lost on how we got this additional investment. Okay. And the question we are told that it is planned that the combined company will require additional investment of 62 million in the first year. While on the 15 francs for every 100 francs increase in sales for each in the next 3 years. Okay, let me come back on it. Let me work. Additional investments. Have 1 and 2. Then we are told that let me first have sales. You know that sales are these are sales. These are sales. Yes, okay. These are sales. And since these are sales, we need to see the increase in sales. Vianney, nizere ko turi kumwe. Increase in sales. Due to here, there is no comparative in the first year. There is no increment. While here, you take this minus this one. See the increment? Take this one, and minus this one, you get this. Then lastly, take this minus this, you get this. Yes, after getting this, we are told that additional investments in year 1, in the first year, it will be additional investment. The first year this one will be 62, while in the next 3 years it will be next 3 years it will be increasing by 15 for every 100 increase in sales. If it is every 100 increase in sales, it is said to be here. This is the formula. Take the increase in sales. Take the increase in sales here. You will take this. Then you multiply by 15. Divide by 100. And this will not change at any. It will remain the same as this one. Yes. Really, this is how I calculated the additional investment. Then hope you get it well. Yeah. Guys, These are our workings. These are our workings. And actually, due to tomorrow is a work, there is a work tomorrow. Let us stop by here so that those who might need help for any case, please don't hesitate to contact me. Yeah, I'll be there to help you. And what I can say here is all about wishing you also all the best. And don't be afraid for the exam. Go for it with your full of confidence. And the keyword or password of success is all about extracting the data in the case study. And after extracting the data, the remaining one is all about linking the extracted data to the case study. And after linking them to the case study, the question becomes very simple. And during determining the marks you are about to get on the question, please mark the easiest part of the question. If it is question one, let me, for instance, give you this. If on this question, you are able to get this for within 2 minutes, please start with this C. And if you are able to handle this under dividend policy, please get these 4 marks within 1 minute. And if you are able to get these 17 marks within 20 minutes, please don't hesitate. And once you combine these, like these 8 minutes, 28 minutes, and spend another 40 or 50 minutes to this 25. And based on the how we extracted our data here in this question, see, we have extracted every detail in the question up to from here up to here. And then we start our working for extracted data. And you remember, we linked it to the paragraph. Yeah. Okay. Okay, guys, let me give you my email. My email is that one. While phone number, that is my WhatsApp now. Yeah. For any assistance, for any guidance, don't hesitate to communicate me or contact me whenever you find any issue which is very tough for you. And don't blame yourself. I know you have a lot. You have a full package. Up to now, I cannot be ashamed to where is it? Which one, Francois? You are asking me where is it? Oh, phone number. Hey, you are not saying it. Let me copy them then. Okay. Okay, guys, write my number, write my number, write my number. 078 078 79 again 330. Confirm whether you complete, you wrote it well, you wrote it correctly. Yes. 078 7979 330. That is it. Yeah. The last nothing complicated mainly. The maining part was all about hedging and a small part of cost of capital, working capital management. What is now complicated. Please find, take your time and correct each and every case under there, and where you stuck, let me know. I will be there to help you. What I wish all of you is all about success in this coming sitting. Let me hope to receive or to receive notification of all of you about your success for this module of to A21, A2.1. I will be appreciate to congratulate all of you for your success. May Lord God be with you and bless all of you. Good night. Okay, well, you are welcome, all of you. Let us see you in the celebration of successful of this module. And thank you for promising me to pass. Yeah. See you. Goodbye.